Hello and welcome. Today, we're going to unpack one of the most misunderstood market events in recent history, the Indonesian equity market shock of early 2026. It's a lesson in how markets work, how liquidity is measured, and why understanding the difference between a catalyst and a cause can save you from making costly investment mistakes. Let's dive in. Early 2026, Indonesia. The equity market experienced 2 consecutive days of violent selling. The pressure was so intense that trading halts were triggered, the exchange's emergency brake to prevent complete chaos. Investors were in shock. Headlines screamed, panic spread, and everyone was looking for someone to blame. The narrative that emerged was simple and emotionally intuitive. Msci caused the crash. It made sense, didn't it? Msci raised concerns, the market collapsed. Cause and effect. Simple, emotionally satisfying, and structurally incorrect. Msci didn't cause this crash any more than a thermometer causes a fever. Now, you might be thinking, I don't invest in Indonesia, why should I care? Here's why. This pattern, structural fragilities hidden beneath the surface, suddenly exposed, can happen in any emerging market, any market where you've put your money. It means higher capital costs when companies need to raise funds. It means sudden liquidity shocks when you least expect them. And it means unexpected volatility that can destroy carefully planned portfolios. If you invest in emerging markets, this matters to you. So if Msci didn't cause the crash, what did it do? Here's the critical distinction: catalyst versus cause. Msci didn't create new problems. It didn't introduce new risks. What it did was hold up a mirror. And when markets look in that mirror and don't like what they see, they react, violently sometimes. But the problem isn't the mirror. The problem is what the mirror reveals. To understand what happened in Indonesia, we first need to understand what Msci actually is and what it isn't. Let's break it down. Msci is a rules engine. That's it. It's not a regulator with enforcement power. It's not an investor deploying capital. It's not a sovereign entity with political authority. What Msci does is create and maintain benchmarks, standardized measurements that global investors use to decide where to allocate capital. It defines what investable at scale means. It sets the criteria. It doesn't make the investments. Now, you might ask, if Msci doesn't have power, why does it matter so much? Because of scale. Approximately $15 trillion in global assets reference Msci indices. 15 trillion. That's not under Msci's direct control, but it's guided by Msci's classifications. Msci is influential not because it commands capital flows, but because it's widely referenced. The difference matters. It's the difference between giving orders and providing the map that everyone uses. Let me walk you through how this influence actually works. First, Msci develops and maintains its methodology, the rules for what counts as investable. Second, these rules shape benchmark indices that institutional investors use for portfolio construction. Third, passive funds, ETFs, index funds, must mechanically match these benchmarks. They have no choice. If Msci changes a classification, they must adjust their holdings. And fourth, when trillions of dollars move based on these adjustments, markets react. This is the transmission mechanism. Msci doesn't pull the trigger, but it builds the gun that everyone else uses. In early 2026, Msci asked a simple question about Indonesian equities. Can large institutional capital enter and exit this market efficiently, even under stress? Not during calm times, not when everything is going well, but when the pressure is on, when global risk is repricing. When everyone wants the exit at once, can capital actually get out? For certain Indonesian stocks, the answer was uncomfortably ambiguous, and that ambiguity is what triggered the sell-off. To understand what MSCI was really asking, we need to talk about free float. The textbook definition is straightforward. Free float is the percentage of shares available for public trading, everything that's not locked up by insiders or restricted by regulation. Count the shares that can be traded, divide by total shares outstanding, done. Technically correct, practically insufficient, because markets don't care about definitions, they care about reality. Here's what free float actually means in practice. It's the proportion of shares whose holders can and will sell rapidly in response to market signals. Not just legally able to sell, but actually able, without board meetings, without committee approvals, without political consultations, without worrying about headlines or strategic considerations. True free float is about behavior under pressure, not legal status on paper. It's the difference between what's theoretically possible and what actually happens when markets break. This brings us to one of the most important concepts in understanding market liquidity: stickiness. Imagine two shareholders, each holding 5% of a company. On paper, they look identical, but one can't sell quickly. They're locked by internal governance, by political considerations, by reputational constraints. Those shares are sticky. The other can execute a sale immediately, no questions asked. Those shares are floating. Both are legally tradable, but only one behaves as if it's tradable when it matters most. Sticky shares stay put precisely when theory says they should move. In calm markets, free float doesn't matter much. Everything looks liquid when no one's trying to sell. But liquidity isn't an average. It's not the sum of normal day trading volumes. Liquidity is what remains when everyone wants the exit at once. And the defining characteristic of true liquidity is speed. How fast can you sell? Not tomorrow, not next week, right now, in the middle of a crisis. Because effective free float shrinks precisely when it's most needed. That's the cruel paradox of market stress. Now we get to the crucial question. When we're measuring free float, who actually counts? Let's break down the taxonomy of shareholders. Think of shareholder types arranged in 4 categories. Top left in red, corporate insiders, founders, executives, board members. These are excluded from free float calculations, no question. Top right in green, financial institutions, asset managers, hedge funds, mutual funds. These are included. They can move fast. Bottom left and right in yellow, the gray areas. Venture capital funds. Financially motivated, yes, but often locked up with board influence and staged exit strategies. And state-owned entities, professionally managed perhaps, but with ultimate decision authority that may rest with government. These are context-dependent. Speed matters more than structure. Why are corporate insiders automatically excluded? 4 reasons. First, information asymmetry. They know things the market doesn't, which creates constraints on when and how they can sell. Second, strategic influence. They're not just shareholders, they're decision makers. Selling signals lack of confidence in their own strategy. Third, non-financial objectives. Their wealth, their legacy, their reputation are all tied to the company's success beyond just the stock price. And fourth, reputational constraints. A founder selling during stress looks like abandonment. They simply don't behave like neutral market participants because they're not. Financial institutions are included for exactly the opposite reasons. Their mandates are purely financial: maximize returns, manage risk, protect capital. No emotional attachment, no strategic considerations beyond portfolio performance. They can make decisions rapidly because their governance structures are designed for speed. A portfolio manager doesn't need board approval to exit a position. They respond to market signals because that's literally their job, and their fiduciary duty requires exactly this kind of responsiveness. But, and this is important, this only holds when their mandates are truly unconstrained. The moment there are hidden restrictions, the analysis changes. The gray zones are where it gets interesting. Venture capital seems straightforward. They're financially motivated, they want returns. but they operate under multi-year lockups. They have board seats, which means information advantages and strategic influence. Their exit timing is coordinated with company milestones, not market conditions. Are they free float? Depends on context. State-owned entities are even more complex. You might have world-class investment professionals running the fund. They might operate under a commercial mandate. But if ultimate authority rests with the state, if exits can be overridden for policy reasons, if political considerations can delay decisions, then delegation isn't the same as independence. The test isn't what the org chart says, it's who can actually press the sell button during a crisis. This distinction between delegation and true independence is critical. Many emerging market governments have created sophisticated investment vehicles, professional management, clear mandates, apparent autonomy. On paper, it looks like institutional investment. But delegation frameworks can be overridden. If decisions can be delayed, reversed, or second-guessed by non-market actors during periods of stress, then the appearance of flexibility is just that, appearance. And if that's the case, then effective free float remains impaired, no matter what the legal documents say. Here's the test that cuts through all the complexity. During a market crisis, who can press the sell button without asking permission? Not tomorrow, after a meeting, not next week, after a board discussion, right now, this instant. If the answer involves a minister, a cabinet discussion, a political calculation, then those shares are sticky, period. It doesn't matter what the prospectus says, it doesn't matter what the governance framework looks like. What matters is speed under stress. Everything else is just paperwork. Some people argue that trading halts and circuit breakers solve these problems. They don't. Trading halts manage volatility. They pause price discovery. They give everyone time to breathe. That's valuable. But they don't create liquidity. They don't increase the number of willing sellers. In fact, they can make things worse by creating pent-up pressure that explodes when trading resumes. Pausing the game doesn't change the fundamentals. When the market reopens, the same question remains. Are there enough unconstrained sellers to absorb institutional flows? If the answer was no before the halt, it's still no after.
So what happens when these structural issues aren't addressed? Let's talk about consequences.
The consequences unfold in 3 phases. Immediately, index reweighting. Msci reduces country allocations or excludes stocks from certain benchmarks. Risk premiums rise as investors demand compensation for structural uncertainty. Medium term, higher capital costs. When companies need to raise funds, they pay more. Valuations compress because the investor base shrinks. Foreign institutional participation declines. And long term, the market becomes less relevant in global portfolio allocations. New listings dry up. Why go public if you can't access global capital? Market infrastructure credibility erodes. These outcomes unfold gradually, but they persist stubbornly. The damage compounds over years. History provides clear lessons. South Korea after the Asian financial crisis, aggressive corporate governance reforms, reduced chaebol cross-holdings, increased transparency. Result? MSCI weighting increased from 2% to 14% over 8 years. Capital costs fell measurably. Taiwan, gradual opening from 1990 to 2003, systematically relaxing foreign ownership restrictions. Each step improved index statement and lowered equity risk premiums. China A shares, despite being the world's second largest equity market, they remain only partially included in MSCI indices. Why? Capital controls, settlement constraints, state ownership concentration. The cost? An estimated 50 to 100 basis points in higher cost of equity capital. And Russia, 2022, the extreme case. When capital couldn't exit freely, investability was revoked entirely, removed from indices. The lesson? Markets that adapt thrive. Markets that resist face prolonged marginalization.
So what's the path forward? 3 horizons. Immediate actions. Mandate detailed disclosure of shareholder composition, beyond just major holders. Formalized governance frameworks for state-linked entities with pre-authorized selling authority during market stress. require independent audits of effective versus nominal free float, strengthen corporate governance standards, limit cross-holdings, enhance minority shareholder protections, and long-term, cultural shift, moving from concentrated family and state control toward dispersed institutional ownership, not wholesale adoption of Western models, but compatibility with global expectations, recognition that liquidity is a competitive advantage, not a threat. Global capital has options. Make your market the attractive option.
Let's return to where we started. MSCI as mirror. MSCI doesn't judge markets. It doesn't impose values or preferences. It reflects reality back to market participants. And when that reflection is uncomfortable, the instinct is to blame the mirror. But the mirror isn't the problem. The mirror is doing exactly what it's designed to do, showing what's actually there. When MSCI raised concerns about Indonesian free float, it didn't create structural fragilities. Those fragilities existed. They'd existed for years. MSCI simply made them visible, and visibility forced a reckoning. The problem lies not in the mirror, but in what it reveals. For investors, this understanding translates into concrete questions you should be asking. About individual companies, who truly controls the shares? Not just legally, but practically. How fast can major shareholders make exit decisions? What layers of approval exist? Has the shareholder base been stress tested under crisis scenarios? About market structure. What percentage of market cap is held by state-linked entities with ambiguous mandates? How responsive are local institutions to global risk-off events? What legal or regulatory barriers exist to rapid capital repatriation? And critically, how does effective free float compared to nominal free float? The gap between those two numbers tells you everything you need to know about liquidity risk. Ask these questions before you invest, not after the crisis hits. We started with a market crash in Indonesia. We end with a deeper understanding of how markets actually work. Liquidity isn't a fact printed in a prospectus. It's a promise. A promise that when you need to sell, you can. That when stress hits, the exit door is actually open. And that promise is only as credible as the behavior of the underlying shareholder base. MSCI's methodology exists to test that promise, not to punish markets, but to measure reality. The Indonesian shock was painful, but it was also clarifying. It revealed what had been hidden. And now the choice is clear. Make the promise credible, or accept the consequences of its fragility. Thank you for watching. If you found this valuable, subscribe for more analysis on market structure, liquidity, and the hidden mechanics of global finance. Until next time.